We have a quick question here from Wojciech, asking some advice about trend lines and support and resistance zones, asking how far we should go back when we draw these lines on the chart. So thanks for the question. Um, I think when we look at something like trend lines and support and resistance, there's obviously a lot of subjective elements to it, right? There are some caveats. With some traders will like to use only the wicks, and others will use only the bodies, and some will use candlestick charts, and others will only use line charts. I mean, there's so many different ways of looking at it. It's definitely not a one size fit all when we look at these types of things. And the only thing that has really helped me with these types of tools when it comes to trend lines and support and resistance zones is two things. Firstly, is to know that there's zones, right? So it's not a strict to the pip value, even though the markets can sometimes respect them to the pip. It's usually a zone and not or an area, not a strict line. And secondly, is knowing that at the end of the day, they're all of them trying to show you the exact same thing, which is just possible areas where the market might find support and resistance. So whether it's a horizontal zone with support and resistance, or whether it's a diagonal zone with trend line support and resistance, you're just trying to establish viable or higher probability places on the chart where price might find support and resistance. And if the level is significant enough, a key break of some of these levels can, of course, create some forceful moves in the market if there was plenty of stops sitting behind those levels. As those levels are tripped, you can normally see a rush to the upside, for example, from some of these key levels. Now, in terms of how far you need to go back with them, the one thing that you can do to help you is just looking at the most recent price action where you are now. So, for example, right here on the S&P 500, we can always go to the weekly, and on the weekly start, frantically marking out key levels on the charts on the weekly, and then doing it for the daily, and then the H4, and all the way up to M30 or M15. But then you're going to be stuck with a chart that's going to look like a Christmas tree, right? Just lots and lots of colors there, major levels all the way around. It's going to be very confusing to just watch the overall price action. So what I prefer to do, especially when you go to the higher time frames like the weekly or the daily, definitely do it, but only mark out those key areas that are major levels on that higher time frame, but close to your price action, right? So if we're going to the daily, mark out the high where we are currently trading at, or the highest point we currently reached most recently, and these lows, anything below or above that it's probably going to be outside the reach of the market today. Now that doesn't mean that it can't happen. So here we have a great example of when the market doesn't really care and just floats through a couple of levels. But again, at that time while we are trading here, the most significant support probably was that low going back to the break of that 3,000 level. So only have those most recent price action levels marked out on the higher time frame, and then what you can basically do is just drop down throughout the throughout the charts and see if you can spot any intraday level. So of course we had that one marked out on the daily. Then looking a little bit more granular, we can see that level is also significant. And just above that, the second level coming in at 3193 and 3200. So that overall zone here is going to be a very important area for the S&P, for example, to the downside. And then you can obviously do the same thing for trend lines. So if you didn't spot one on the daily, spot one on the H4, we can see we have a little trend line extending up, and that's evidently where we test today as well. And now what you can do is you can always drop down into lower time frames and see if you can maybe make those levels a little bit more accurate. So let's move this one over to the wick low. Of course, you don't have to do that. It's just something that you can do to make it a bit more accurate. Then you can drop down to the M30 and just do the same thing, saying, okay, I actually want to extend that a little bit down. Want to include that on the wick. And let's just see what it looks like on this side. So we're happy with that. And now we can go back to where we are currently, and we can see evidently that's where we found some support, bounced up, found support again, and now we're currently supported on that level. So just think of it in terms of where you think the market would find most likely support and resistance areas, whether that is horizontal, whether it's diagonal, and in terms of how far you need to go back, just look at the most recent price action. You don't need to go and mark up the chart, forever to kingdom come. I mean, looking at the euro dollar, we've been trading this for a while to the upside now. And what you'll notice, if I go out to something like the let's go to the H4, many of these downside levels that we've had marked up for a while, we've basically gotten rid of them now because it's just not that important right now. The thing we need to mark out now and focus on is the levels to the upside and these most recent levels. So you don't have to go, all the way back to 1980, for example, to go and mark out your levels on the weekly and the daily. Find those key areas close to where we're trading right now, and then as you go through the timelines or timeframes rather, just mark out those key levels that's going to be most important for your most recent price action. So I hope that helps there, Wojciech. Any other questions, please don't hesitate to let us know.